Hey there, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, October 28th, 2023. How you doing? Appreciate you tuning in to this week's stock market review of all my trades and how I'm going to manage them going forward. Boy, what a week we've had. A lot of turmoil in the market, a lot of volatility in the market. Boy, it's been something. Hope you're staying safe out there and following your process. But yep, as I said, thank you for coming. Hope that by investing some time in listening to this podcast, it's going to be helpful for you. So here is the format and what we're going to do today. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back and we are going to take a look at all the trades that I made last week, both on the daily time frames and the weekly time frames. We are going to talk about when I entered the trade, why I entered the trade, what strategy, which setup I used to enter the trade, and then most importantly, how I am going to manage that trade going forward, either to the upside or to the downside. It's very important when I look to enter a trade that I have a full process. I have if then statements. If this happens, I'm going to do that. If that happens, I'm going to do this. In general, what I am looking for is I'm looking for some kind of rejection of a major level, like a 30 RSI level, a 200-day moving average, a 250-day moving average, a 300-day moving average, a V1 or a V2 entry. I like to look on multiple time frames for multiple levels of support. And basically, when you boil it down, what I'm really looking for is I'm looking for a confluence or a combination of indicators lining up, ideally on multiple time frames. Doesn't mean that it's going to be a profitable trade, but every indicator that you can get that happens at the same time does improve your chances of having a profitable trade. And of course, you need to position size correctly. The way that I do it is I have an emergency stop. I also have an end-of-day stop that gives me a good risk to reward ratio. If the price moves in my favor, I always take a partial profit of just a small percentage of my position. And then I have rules. I have rules. If I get 1.5 ATRs above my entry, then I go into trailing stop mode. I have all sorts of rules for all different type of strategies, and they don't always work. But if you want to be a profitable trader over time, you really need to have a process. You really need to do all sorts of things. It's not just where to buy. It's where to buy, how much to buy, where your emergency stop is, when your end of day stop is, how you're taking partial profits. If you get to a certain level above your entry, you go into trailing stop mode so that you are tightening up that stop all the time. And then if you get into levels like 65 RSI level, 70 RSI level, different rules with that as well. But so we'll take a look at all the entries that I had, when I bought them, why I bought them, and like I said, most importantly, how I'm going to manage them going forward. After that, we're going to do a little bit on trader psychology. Always the most important skill in trading is the ability to create a plan and then follow that plan, everyone. You have to follow that plan. You have to know exactly what you're going to do. But if you're not psychologically, if you're not able to follow that plan, then you can have the best plan in the world. What good is it going to do you? Right? So it's important that you learn to create that plan and follow that plan. So we'll touch a little bit on trader psychology. After that, I have gone down through my watch list, both on the daily time frames and the weekly time frames, and I have identified some potential trades next week that I am interested in. They're not where they need to be yet. If they were, I probably would have already taken the trade. But we'll go down through and I'll show you what I am looking for, and hopefully that's going to be helpful for you. But like I said, it has been an extremely volatile market. We have interest rate issues going on. We have conflicts in the Middle East that are definitely affecting the market. So it's a pretty tumultuous time. But on the bright side, even though we've had this pretty dramatic sell-off, there are some really good potential levels We're near them right now. So we either need to go down a little bit more to touch some of those levels, or we need to go up a little bit more as well. And in addition to going through the trades, I will go over kind of the major indexes. We'll talk a little bit about bonds. We'll talk a little bit about the dollar, and we'll try to look at things that way, and hopefully gives kind of maybe an idea of where the market's going to go. All right, so that's the plan for today. Hang tight. I'm going to run the U.S. legal disclaimer, and I will be back in about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding on with me here, everyone. And like I said when we started the podcast, I'm going to show you the rules that I have here, how I position size, emergency stop, end of day stop, taking partial profits. But if you're interested in trading, you're interested in really learning how to develop a process, a full process of everything you need to do, so you have if-then statements. If you're interested in working one-on-one with me, I do offer private one-on-one trading lessons in the evening time. I have a 15-hour course, 3 hours each session, total of 5 sessions. I teach you step by step everything. I'll teach you everything I've learned and everything that I do and how I've traded over the last 28 years as well. So if you're looking for a good coach, if you're looking for good instruction, please let me know. I've taught people from absolute beginners all the way up to hedge fund managers as well. So if you're interested, my contact information is in the description of this video. All right, here we go. Let's get started. VIX. Well, I'm really glad that I had VIX. Over in this area here in September, I was talking about a potential shift in market structure, and you can see the green box. This is the fair value gap here that I denoted. But basically here we have a level of liquidity. We ran the level of liquidity to the downside. Then this big move up here moved over this swing high here. This changed the market structure to an upside. And then we have this gap. We have the area of price from the high of this bar to the low of this bar. This area here was never tested. And so what I mentioned was, if we come back into this green area, we're probably going to bounce. Now, I didn't get this trade right here, but I mentioned that if we do come back into the green area again, I would buy it. And here on this day, it closed here. And so I had a confluence of signals. We tested the fair value gap, and then we also had a V1 entry. Here is bar 1, here is bar 2. Bar 2 went below bar 1's low, closed above bar 1's close. This is called the V1. There's also something called the V2. If you'd like to learn more about V1s or V2s, the link is in the description of this YouTube video. You can also go to my YouTube channel and just look in the lessons playlist under V1s or V2s. They're a very important part of my trading, and they really are good entry triggers, especially when you combine them with other technical signals like deep dip buys or fair value gaps, as you can see here. So anyway, I bought here on the 12th of October at 22.58. I position size correctly based upon volatility by taking 1% of my trading account value, dividing it by the value of the 2 ATR. That shows me exactly the correct amount of shares to buy based upon the current market volatility. So then I place my emergency stop exactly 2 ATRs below, so that if it does get down to that level, then I'm going to get out and I'm going to lose 1% of my capital. Worst case scenario. Now, I also had an end of day stop. Well, on a V1, the end of day stop is halfway of the washout bar. This is bar one. This is bar two. Bar two goes below the low of bar one, closes above the close of bar one's close. Excuse me, everyone. I have had quite the cold this weekend. So if I cough during this podcast, please forgive me. Doing my best, but boy, I have been down. I have been in bed for the last week other than trading. But here's the top of the washout bar. Here's the bottom of the washout bar. Halfway here, simply if, I bought here at 22.58. Simply if it closed below here, I would simply get out of the trade. That's it. Now, I have this orange line up here. This is exactly 1.5 ATRs above my entry. Now, your emergency stop is 2 ATRs below your entry. Your 1.5 ATRs is above your entry. Now, once I get here, I go into what is called trailing stop mode, which means that if I have a close below a previous bar's low, I will get out of half of the position. And I'll show you that when that happened here over on the 23rd. And in addition to that, whenever I enter a trade, like I mentioned at the beginning, if we move the value of 0.45 ATRs, in this case it's 82 cents right now, above the previous bar's close, I get out of 10% of the position that I have remaining. So bought here 22.58. You can see the next day we had a huge day up. I hit all three of my partial profit targets, took those off, locked those in, reduced my position size, reduced my overall risk. And on the very next day, we got to trailing stop mode, which means now that if I have a close below a previous bar's low, I will get out of half of the remaining position. So anyway, hit three profit targets. It was a big day. It was a huge day. Next, now I'm in trailing stop mode. I'm looking for a close below previous bar's low. Didn't happen here. Here we went below, but we closed above. Then we moved up here. I took some more profits. Moved up here, took some more profits. Moved up here. I don't think there was profits there. And then here on the 23rd was the first close below a previous bar's low. After reaching trailing stop, I sold the half of the remaining shares that I had for a gain of 11.59%. Next day, we went down a little bit. We had another big bar up, took some more profits. Next day, took some more profits. Next day, took some more profits. And the remaining shares that I have right now on this position, really good trade, up 16.73%. So I'm really glad, obviously, that I bought VIX here, especially in light of what's going on in the Middle East and so forth, because it did help to minimize the losses that I had on my other equity swing trades this week. But anyway, still in the position, up 16.73% on the remaining shares. SPY. Well, SPY did not work out so hot tamale, and you can see I took, rarely happens, but I took two trades on SPY. I took the first one here on the 24th of October. Why? It was a nice confluence of signals. You see the black line here is the 200-day moving average. We closed underneath the 200, then we closed above. That was my entry point. We also had a V2 entry trigger, bar 1, bar 2. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. Really good setup. This one didn't work, but really good setup. Close under 200, over 200, and a V2. Got long here 423. My emergency stops 2 ATRs below. My end of day stop is simply a close below a close below the 200, because that's why I took the trade in the first place. Close under, close over. But the next day just got walloped, closed below the 200 day. I had to get out for a loss of 1.47%. Next day, glad that I got out, obviously, because we had another huge down bar. But I took the trade again on Thursday because different trading approach, but we went under the 30 RSI and closed back over the 30 RSI. That was my entry signal. So I position sized, I placed my emergency stop 2 ATRs below, I placed my 1.5 ATR trailing stop above, but we started off positive on Friday, and then boom, we closed below. You can see 29.11. If it would have stayed above 30 RSI, I would have stayed in the trade, but it closed below. And so I took a loss of 0.46%. But what you'll see, everyone, is that all of my trades are not winning trades, obviously, but what you will see is if I'm in a trade for a long time, it means that it's positive. I guarantee you, if I'm in the trade for a long time, it means that it's a positive trade. If I take a trade and you see me get out quickly, it's because it untriggered my entry. So very important, be very patient with your winners and be very impatient with your losers. I have lots of losers all the time, but they're quick and they're fast, and I'm out usually in a day or two if I'm wrong, just like the one that I took here. Entered, next day wrong. Thursday, entered, next day wrong, and I'm out. But this was down 1.47%. The one that I exited on Friday down 0.46%. So you're going to have those losers, but when you're wrong, be wrong quickly and small. All right. So, yeah, Friday's exited for a loss of 0.46%. I'm going to take these things off here because this is in my list of something to buy possibly on Friday. All right. Next exit. Now, this is a really good example of the rules that I use in trading and why they're so important to learn. This is a very, very good example of this. So I did get long AMD back here on the 25th of September. Why? Well, see the black line, this is a 200-day moving average. This is a very important level that large financial institutions and experienced traders will key off of for a good risk to reward ratio. So during the day, we went below the 200, but then we closed above. I make all my buying and selling signals based upon the close of the market, except for my emergency stop. If I hit my emergency stop, I get out whenever that is, even 1 minute after the market opens or 1 minute before it closes. But on the entry signals, I always wait till the end of the day because I feel like the end of the day prices are the most important. So during the day, we went under the 200, closed above the 200. So now I have that support of the 200 below me. We also created a V1 entry signal. Here is bar 1. Here is bar 2. Bar 2 goes below the low of bar 1, closes above the close of bar 1. So I have a nice confluence. Remember, confluences are very important. Intraday rejection of the 200 and a V1. So I position size correctly. I placed my emergency stop exactly 2 ATRs below, so I know what my maximum dollar loss is and percentage of my account loss is. And then my end of day stop is simply a close below the 200-day moving average. The next day did go down, but you see how it touched the 200 again and closed above it? That's what kept me in the trade. Now I place the orange line. I place my 1.5 ATR trailing stop level above, 1.5 ATRs above my entry. And it's again, if it moves up in my direction, I'm always going to take partial profits. So it tested the 200 again, then moved up, which I knew was a good sign. Moved up, I took some profits. Next day, we had another huge day up, took more. I believe I hit 2 profit targets, and then I got into trailing stop mode, which again means that if I have a close below previous bar's low, I'm going to get out a half. We had a couple days where it didn't do much. And then here on the 3rd of October, we had our first close below the previous bar's low. I got out for a gain on the remaining shares of 3.54%. And you'll see in the future here why that was so important, that I took a substantial amount of my trade off here with the first close below the previous bar's low. Then we had another big up move, took partial profits here, took 2 partial profits here, took another partial profit here, took another partial profit right at the top. I kept reducing my position size, and then everything changed. Down, 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 down. And on Wednesday, we finally closed below the 200-day moving average. Now keep in mind, my position size extremely small at this point because of the partial profits, taking half off here, lots and lots of partial profits here. So here on the remaining shares, I had a loss of 0.54%. But was this still a profitable trade for me? Of course it was, because I took all these profits, took half off here, took partial profits all the way up here. So yes, the remaining 20% or whatever I had here, I had a loss of 0.54%. But because of these rules and the taking the partial profits and the trailing stop levels, this was still a nice positive trade. Now, if you would have just mechanically bought over the 200, you would have had really nice gains. and then close below the 200, you would have ended up with a loss after holding this for over a month. I guess it's a month. 925. Yeah, almost exactly a month. But because of the partial profits and the trailing stop rules that I use, you can see this is a very good example of why it's so important to learn these things, because every once in a while, yes, you'll have a straight up move, but they don't happen very often. More often than not, you have this kind of stuff. So the remaining shares on this trade, loss of 0.54% and out of AMD at this moment. All right. So those were all the daily, I guess, do a recap real quick. Daily trades, VIX, remaining shares up 16.73%. SPY, oh, what was that? Last trade on SPY minus 0.48%, so a small loss. And then AMD 0.54% for a small loss as well. So those are the dailies. Let's go to the weeklies now. And this has been a really great trade on gold for me, GLD. I bought it all the way back here on the 6th of October. Why did I buy it? Well, look, we have the 200-week moving average. That's a major level of support. You can see this gray line here. This is the negative third ATR channel. About 92% of prices stop going down when you get to this negative third ATR channel. 92%, not 100%. 8%, they can still go down, right? But what I liked here was the confluence. I like the confluence of the rejection, intra-week rejection of the negative third ATR channel, and also the rejection of the 200-week moving average as well. So I position size. I place my emergency stop 2 ATRs below. My end of week stop is what, do you think? Why did I take the trade? I took the trade because of the rejection of the 200-week moving average. Therefore, the next week, if it had just closed below the 200-week, I would have just simply been out for a small loss. Very good risk to reward ratio. Orange line, my 1.5 ATR trailing stop level. Next week, well, off to the races. Up we went. I believe I hit 2 profit targets on this particular trade. Took those off, reduced my position size, locked those profits in. We also got to trailing stop level, which means now in the future, if I have a close below a previous bar's low, I will get out of half of the position. Next week, up again. Took more partial profits off. I believe I hit 1 partial profit on this particular week. Did not close below the previous bar's low, so no trailing stop action is needed. And then this week, again, we were up another 1.39%, and I did hit another profit target as well. You can see the 0.45 ATR is $1.81. We went up 256. So yeah, so I took the close. I added profit targets at 1.81% above as my first profit target. And you can see we hit that. So I took it off again. So in trailing stop mode, we have not triggered any trailing stop signals. I'd have to have a close below a previous bar's low. Now, I talked about all the different rules. We are at a 60.64 RSI level, which means now next week, if we continue up and we reach 65 RSI level, then I'm going to tighten up my stop even closer. And you can see this thin blue line here. This is the 5 EMA. If I get to 65 RSI and then I close below the 5 EMA, I'm going to exit the entire position. It's a really good rule, something I've used over many years in trading. But we have to get to 65 RSI level as well. Alternatively, if we move up and we reject the 70 RSI, then I will exit half my position. And then if that happens in the future, if I have a close below a previous bar's low after rejecting the 70 RSI, then I will be out of the entire position. All right. And again, these are all the things that I teach in my one-on-one trading class. And I know if you're just new to this, you might, boy, there's a lot of rules. How would I remember all that? Trust me, I will teach you. And so this particular trade doing very well. Remaining shares up 8.86% on the weekly time frame. XLF, oh boy, I was almost hoping that I would get out of this trade because I'm kind of tired of talking about it. I've talked about it for so long, but what does that mean if I've talked about it for so long? It means that this has been a profitable trade is what it means, right? Patient with winners, impatient with losers. So XLF, Financial Select Sector ETF, I bought this all the way back here on the 24th of March. Why did I buy this? Again, weekly trade, weekly bars, and on Friday. Well, here was the 250-week moving average. You see how during the week we came and tested it and then closed back above. That was my entry signal. I entered here at $30.71. My position size, I placed my emergency stop 2 ATRs below, and then my end of weekly trade. So end of week trade would simply be a close now below the 250-week moving average. That's it. So position size, emergency stop 2 ATRs below my end of week stop. I know it's close below the 250-week moving average. Now I have to take my entry and add my 1.5 ATR trailing stop level, which is 1.5 ATRs above. If I get there, then I go in again to what's called trailing stop mode. And again, bar to bar, if it moves the value of 0.45 ATRs from the previous bar's close, I take partial profits. Next week, up nicely. Took some profits off, reduced my overall position size. Next week, nothing. Next week, another big, nice bar up, hit another profit target, got to trailing stop level, which means now if I have a close below a previous bar's low, I will exit half of the shares that I have remaining. Next week moved up a little bit. Can't remember if I hit a profit target on that. I don't think so. Next week, we went below the low, but closed above, so it kept me in. Next week went below the low, closed above, kept me in. We had a month of sideways motion, nothing happening. Then we moved up here. Then we moved up here, did take a profit target off here. And then this week, the 23rd of June, we had our first close below the previous bar's low. I exited half of the position for a gain of 6.4%. Then we had a whole month of up, took profit targets here, took profit targets here, took profit targets here, right at the very, very top of the market. Of course, then we moved down for a month. Then we had another move up where I luckily took some more profits off. And then for the last 6 weeks, of course, we have just gone down. Now look, here's the 250-week moving average. Do you see how we went below it but closed above it? So it kept me in the trade. If we would have closed below this 250 now, I would have been out of the trade. And like I said, I was kind of hoping, because I've been talking about this trade for months and months, but it's a good example. One, if I'm in a trade for months and months and months, it means that it's a positive trade, right? And again, this is also a good teaching example of why taking partial profits, why having trailing stop modes, again, why taking partial profits is so important. So the remaining shares, because I've been in the trade so long, the remaining shares are still up 2.45%, which is good, but I am up way more than that on this trade, again, because of the partial profit rules, the trailing stop rules here, a month of partial profits up again. So again, the small amount of shares that I have remaining are up 2.45%, but I'm up a lot more than that, again, because of the partial profits and the trailing stop rules. So I think this is a good teaching example of what I use here and what I do is so important. Okay. FXY. Whoa. Oh, yep, there we go, FXY. All right, FXY is a trade that I did take, a new weekly trade that I did take on Friday, yesterday. Why did I take the trade? FXY is basically Japanese yen. And, the Japanese yen has just been going down and down and down and down. So why in the world would I buy this? I mean, look at this move. Well, I bought it because I had the signals. What's the signal? Look at the RSI level here on the weekly, 30.47. So during the week it was lower, then it closed above 30 RSI. That's my main signal. In addition to that, I had a V1, bar 1, bar 2, bar two goes below bar one's low, closes above bar one's close. There is my confluence combination of indicators lining up. So let's just do a quick position sizing so I can show you. So let's just take a hypothetical $100,000 account. If we take a $100,000 trading account times 1%, tells me that my max loss is $1,000. If it was $200,000, my max loss would be $2,000. It was $50,000, my max loss would be $500, right? So hypothetical $100,000 account times 1% is 1,000. I divide it by the value of the 2 ATR. The 2 ATR is $1.99 divided by $1.99. It's telling me to buy 502.5 shares. So I'll just round that up to 503 shares. So now I know how many shares to buy. And then I take my entry price minus 199. This is the red line down here. This is my emergency stop. So basically, if I have 503 shares and it moves down $1.99, how much do I lose? $1,000, because we did the math already. So my emergency stop here, I would lose $1,000. Now, keep in mind, only 5% of the time will you hit your emergency stop. The other 95% of the time, you're going to hit your end of week stop or your end of day stop. Well, what is my end of day stop? Well, why did I take the trade? The main reason I took the trade was not the V1. The V1 just helped the main reason I took the trade. But the main reason I took the trade was the under 30 closing back over 30. So next week, if it closes back under 30 RSI, even if it closes at $29.99, I'm just simply out of the trade. That's it. If it moves up, then I'm going to take partial profits. Like just for example, right now it's 62.10. So I'll take 62.10. What's my 0.45 ATRs right now? The value of the 0.45 ATR is ironically 0.45. So I take 62.10 plus 0.45. 62.55 will be my first profit target next week. First profit target. How do I get my second? Well, I take my first profit target. I add the value of the 0.45 to it again. My second profit be exactly 63. Then I take my second profit target, add the 0.45 to it again, 63.45. So I know what my 3 partial profit targets are for next week. Okay? So if it moves up and I hit those partial profits, I'll take off 10%. If it closes below the 30 RSI, I'm simply out of the trade for a small loss. It hits my emergency stop. I'm just out of the trade and I know I've lost only 1% of my account. If I get to my trailing stop level, this is the orange line. How far is this above my entry? 1.5 ATRs above my entry. Then I go into trailing stop mode. So I know I don't care what this does. In the worst case scenario, gets down to I lose 1%. Okay, not fun, but certainly recoverable, right? Only 5% chance of that. 95% chance if I have a loss, it'll be an end of week stop, which will be probably a small loss at some point, right? I mean, if it closes at $29.99, yes, it will be a loss, but I'll just get out. If it closes down here, yeah, maybe I'll lose, I don't know, $200 or here, $500 or here, $750. Max loss I can lose is $1,000. But then again, if it moves up, I'm taking partial profits. It gets to my trailing stop level, then I go into trailing stop mode, tighten that up. But I really like this setup, honestly. I like the sideways motion, the under 30, over 30, and the V1. So I don't care what FXY does. I know exactly what I am going to do. And that is key in whatever you're doing, everyone. All right. So currently, I think, yeah, FXY up slightly, 0.06%. So I just entered that. All right, let's get over to Home Depot. Another weekly trade. Now, this was a losing trade on the weekly. I bought this here on the 20th of October. Why? Little bounce right at the 200-day moving average. Position size, place my emergency stop below, place my 1.58 TR trailing stop above. End of week stop is where? Simply a close below the 200-week moving average. Well, it definitely closed below. Didn't get to my trailing stop. Didn't get to my emergency stop, right? So I probably lost, yeah, 3.06% totally on the trade, but as far as total capital, it was only about 0.33%. But yeah, from entry to exit here, percentage wise, was a loss of 3.06%. All the trades aren't going to be positive, but again, if I'm wrong, I'm just wrong quick and I'm out. If it comes back above the 200 week moving average again next week, I consider getting back in, right? Or if it gets down to a 30 RSI, I can consider getting back in. So this is a loss of 3.06%. And then last but not least, Apple did not have a good week on Apple. I really like this setup. This is something a little different. This is called a return to value V1 or V2. The green line here, the green line here, everything in here is called the value zone. I don't like to buy above the value zone. I like to buy in value, sell above value, or buy below value, sell in value. The setup is as follows. We were above value. We came into the value zone. We went above value again. We came back into the value zone. We had sideways motion, and then we had a V2 trigger. Bar 1, bar 2 goes below the low of bar 1. Bar 3 closes above the close of bar 1's close. This is called the V2 in the value zone. So return to value, V2. I position size correctly. As I mentioned earlier in the podcast, I placed my emergency stop 2 ATRs below my entry. And then your end of day stop on a V2 is simply a close below halfway of the washout bar, kind of like I showed you on VIX. So from the top to the bottom, halfway is this pink line. If I close below that pink line, I'm out. So I bought here 175.30. Next week, we moved up. Not enough for a profit target, unfortunately. We moved back down the week before last. We held, but this week we closed below halfway of the washout bar, and I had to get out of the trade for a loss of 4.19%. So does that mean I lost 4.19% of my money? No, because I position size correctly. Remember, if we get down to the emergency stop here, I've only lose 1%. So this was, I don't know, about a 0.5%, maybe. So anyway, kind of a bummer trade on that. But again, they're not always going to work. But when your stop is hit, you just get on. You just get on out. All right. So that was those are. We'll just review real quick. Gold up 8.86%. XLF up 2.45%. FXY up 0.06%. Home Depot down 3.06%, and Apple down 4.19%. So it wasn't the best week of all, but I'm sure glad that I had VIX. I'm sure glad that I had gold. I'm sure glad on FXY that I followed. I'm not XXY, sorry, XLF, that I had signals to follow, and that in hindsight, if I could get this right, I apologize, everyone. In hindsight, XLF was a huge winner, and I took lots of profits off because of those partial profits, and super glad here that I got out of half the remaining shares. All right, so those are the trades. Kind of a tough week all in all, but as I mentioned at the beginning of the podcast, I think there are some opportunities for us coming up next week. All right, everybody, let's get a little bit into some trading psychology. This is from Money Trade Edge, Better Thinking, Better Trading over on Twitter or X. And really like this channel. Always puts out great posts, short to the point, but with a lot of meaning. A disciplined trader with an edge will always beat an intelligent trader without an edge. And, there's been discussions about this concept for a long time. Who makes the best trader? Is it super, super smart people? In my opinion, it is not. I believe that is a handicap to be too smart, because you try to outthink the market instead of just following the process of what the market's doing. Interestingly, back at the very lows in the market in October of 22, do you know that there was the highest put volume in history? Meaning that more people in the history of the world at the lows bought puts because they thought it was going lower. Very smart, intelligent people, by the way. At the high in July or August, at the very top, the top of the top of the top of the market. Here, let's find an example. This was on the Qs. Here, in July 21st, at the very top, the most call buying volume in history occurred. How is that possible? Here's the low, the highest amount of puts. That's a bet that it's going to go down lower. Oops, guess they were wrong. The very top, the highest amount of call volume, which is a bullish bet. Oops, they were wrong. So how does this happen? Well, these were some very smart people. Not so smart in hindsight, right? But an a disciplined trader with an edge will always beat an intelligent trader without an edge. I would rather take someone that didn't know anything about trading whatsoever and teach them the correct way to do it from the very beginning. I think sometimes being too intelligent, you think you can outsmart the market. It's hard to outsmart the market if you just follow the signals, everyone, and you have some rules that you follow. And when I'm talking about rules, I am never in a million years going to buy anything up here. I don't like to buy anything above the value zone. So I certainly wouldn't buy above here. Now, would I have bought down here? Well, yeah, actually I did. XLF, right? Even though it was scary, I didn't let the news and the headlines scare me. I just went off of my signals. I certainly wouldn't buy up here. Again, that's what I teach my classes. Never buy up here. This is usually the top, and it certainly was the top, right? So a disciplined trader with an edge. What does disciplined trader mean? With an edge mean? It means you have an edge. It means you key off of certain levels. You have good risk to reward ratios. You position size correctly. You get out quickly when you're wrong. You have a process and a plan, if then statements to do anything. So a disciplined trader, you can have the best trading system in the world. You can have the best process in the world. If you don't follow it, what good is it? So disciplined, that means you're following your process. Then have an edge. Will always beat an intelligent trader without an edge. You need an edge. Casinos in Las Vegas and around the world, they all have a mathematical edge, and they follow the process and the rules of the game. So thank you very much, Money Trade Edge. Better thinking, better trading. Appreciate that. But again, and I come back to this every week, get yourself a process using good trading fundamentals. And the most important thing is when you have that, follow it. That's what's going to get you the money. All right. All righty. So, hey, by the way, if you're watching this and you've learned anything today, if you found it helpful, I really would appreciate it if you could hit the thumbs up button. Helps to build the channel, helps to keep the channel around, and lets YouTube know that there's some valuable content here so they can share it a little bit more. All right, so I talked about that I went through my master watch list, both on the dailies and the weeklies. Don't have a lot of potentials for next week. Yes, there are a lot of things oversold at the moment, but I tried to narrow it down to what I like the best, what I'm looking for the best for me. So here's NVIDIA, NVDA. There are a lot of markets at the 30 RSI. There's a lot of markets under the 30 RSI. We're not quite there yet on NVIDIA. It is having some relative strength. We're at a 3785 RSI. What I'm looking for, you can see here's the negative third ATR channel. And again, 92% of prices when they get there bounce or stop going down. Look over here. Got there, bounced. Look, got there, bounced. We're getting close. We're getting close. And what I'm really looking for is an under 30, over 30 at the very least. An under 30, over 30 with the V1 or V2 would be better. So I think that at these prices, NVIDIA is offering some potential good entries for me here as well. But my first stop that I'm looking for is an under 30, over 30, ideally in conjunction with a negative third ATR channel. If we go much lower, the 200-day moving average is way down here. I don't know if it's going to get there. I kind of doubt it, but if it does, I will definitely take a look there. But for NVDA, for NVIDIA, what I'm looking for is an under 30, over 30, ideally if it dovetails with the negative third ATR channel. On top of that, if we had a V1 or a V2, that would definitely add some extra bonus points. QLD is double leverage Qs. We're at an very interesting spot here on QLD. We're at a 33.76 RSI. If we go lower, an under 30 over 30 may possibly trigger. That would be an interesting spot for me. If we go higher and close back above the 200, that would also be a potential entry signal for me as well. You can see on Friday we had an inside day, which means the high is below the high of the previous bar and the low is higher than the low. So this bar would just fit nicely inside here. So it's inside day. A lot of times when you get inside days, if you take out the low of the inside day, you'll go lower. If you take out the high of the inside day, you'll go higher. I think we're in an inflection point right now with the Qs and QLD. If it goes lower, what I'm looking for is a rejection of the 30 RSI. If it goes higher and closes above the 200, that would also be a potential position for me to take. So it just needs to go lower or it needs to go higher. I would like it a close over the 200. I think that would make sense. Have that support of the 200 underneath me, or if it goes lower, under 30 over 30. If we have a big down bar next week, then obviously the 250 here would also be a possibility as well. So a lot of potentials here with QLD. Either a close back above the 200, possible entry, or if we go lower, under 30 over 30. That's QLD. Let's look at Qs. All right. Qs are interesting. We are not quite to a 30 RSI yet. Let's see. I don't think we were on Thursday. No, 32.31. So it is holding that key 30 RSI level at the moment. On the Qs itself, first stop under 30 over 30 is what I would look for. An under 30 over 30, nice if it dovetailed with the negative third ATR channel as well, or if it goes lower, a bounce of the 200, I would definitely look at that as well. Looking at this chart, it took me back to when I first started trading 28 years ago, something called a wolf wave. And there is a wolf wave, a perfect wolf wave forming right now on the Qs, which does give me some hope for a rally. Here is point 1. Point 2 goes above point 1. Point 3 goes below point 1. Point 4 is in the middle. And then point 5 is here. So point 1, point 2, point 3, point 4, point 5. And the wolf wave would imply that if we get an entry signal, that we will go all the way back up to that trend line. See how it's kind of a megaphone up, megaphone down. And so if I do get a trigger of an under 30 over 30 or a rejection of the 200 there, the wolf wave would tell you that you're going back up here. Whether it does or not, I have no idea, but I have seen these work very often. But just to recap, we're at a 34.34 RSI. An under 30 over 30 would get me interested, or a bounce of the 200-day moving average would get me interested as well. SPY, okay, I took 2 shots at this last week. Both of them did not work, but we are at an interesting spot right here. Do you see the 300-day moving average? This is the orange line here. We are underneath it, and we are also underneath the 30 RSI. One of the best signals that you can get is an under 30 over 30. At the same time, you go under and back over a major moving average like the 300-day moving average. So, and you can see here's the negative third ATR channel as well. This is probably my favorite trade at the moment because of all the confluences. Yes, we're under the 300-day moving average. Yes, we're under the 30 RSI level. We've already rejected the negative third ATR channel. So Monday, Tuesday, next week, if we close above the 300-day moving average, we will also close above the 30 RSI. Very good risk to reward setup. Does not mean that it's going to have to be profitable, but you back test these confluences and under 30, over 30. At the same time, you go under and over a major moving average, one of the best setups that you can get. So that's what I'm looking for. So real quick recap, NVIDIA looking for an under 30, over 30, in addition to a rejection of a negative third ATR channel. QLD looking for, if we go up, possibly a close over the 200-day moving average, or alternatively, if we head down, under 30, over 30. Qs, this would have to move down for me, under 30, over 30, or if it goes lower, rejection of the 200-day moving average. And then SPY, probably my favorite out of all of them because of the confluence of signals. If Monday or Tuesday or next week we close above this 300-day moving average, we will also close above the 30 RSI level, and we've already rejected the negative third ATR channel. So, it's possible that all of these these markets could potentially trigger on the same day. Does that mean I would take them all? No, I would narrow it down to the best one. And what would make the best one? The one with the most confluences of signals. That's why I kind of like SPY the best, because under 30, over 30, under the 300, over the 300, already a rejection of the negative third ATR channel. But I would also look at the multiple time frames. I would look at the risk to reward ratio and how many confluences, did one have a V1 or a V2 trigger? That's the key point. And again, that's what I teach in my private one-on-one lessons. The devil's in the details, looking for the setup that has the highest score, and basically that means the one that has the most confluences of signals, both on the daily and the weekly time frames. And then we can also factor in relative strength and things like that as well. All right, so let's go to the weeklies now. Excuse me, everybody. Dow Jones. My gosh. Excuse me, everybody. This cold. Dow Jones, if we look at this chart, what's the first major level that kind of jumps out at us? These are weeklies, right? These would close next Friday. 200-week moving average. Black line here would make a lot of sense. Is it going to get there? I don't know. If it does, if we have a bounce at the 200-week, or if we have an intra-week rejection of the 200-week, I would definitely consider getting long DIA, which is the Dow. Coca-Cola, KO. All right, so Coke already did have a close under, close over the 200, a little bit stronger than a lot of the rest of the markets. Would I buy it up here? No. Could have bought it here. That would have been legit with the close under 200, over 200. But what I'm looking for is a pullback and a test of the 200, which would be better because it would be a higher low test of the 200. This is a lower low, close under, close over 200. What I'm looking for is a high, ideally would be anytime you have a higher low anything, it's better, whether it's a close under, close over 200. You can see this came from a lower low. If we were to come back test that 200, then close back above, that would be a higher low, close back above the 200. And that would certainly get me interested in Coca-Cola. Morgan Stanley, boy, really getting hammered here. What I would really like to see on Morgan Stanley is this 250-week moving average right at about 67.10. So it would have to come down another $3. But the reason that I picked that level instead of the 200 level is that if we get down to this 250-week moving average, we will also have tested the 30 RSI level. And again, just like I talked about the SPY on the daily time frame, confluences of signals are really the best. So banking stocks very, very weak, but rejection of some kind of rejection of the 250 next week, in addition to a rejection of the 30 RSI level, would certainly get me interested in getting long Morgan Stanley MS. Here is SSO. This is double leveraged SPY. Close over the 200, I'm not sure because of the huge down move. What I'd really like to see, ideally on SSO, would be a test of the 250-week moving average. That would also put us in the low 30 RSIs, so for a nice confluence there. And then last but not least, XLV, healthcare sector really got hammered last week. My gosh. Um, I would consider taking a trade off of this 200-week moving average right here, but you can see we did not get down there yet. So next week, if we go under the 200, then close back above the 200, or if we bounce at the 200, I would consider getting long XLV. So just a quick recap: DIA looking for some kind of rejection of 200-week moving average. Coca-Cola looking for a back test, a higher low back test of the 200-week moving average. Morgan Stanley, not going to get involved in Morgan Stanley unless I have a rejection of the 250-week moving average. SSO, not going to get interested unless I get a rejection of the 250-week moving average. And XLV, I would consider taking a trade on XLV with a rejection of the 200-week moving average, because you see the negative third ATR channel here. See how they've dovetailed together here and kind of nesting together. If I get some kind of rejection next week of the 200 moving average, I would consider that. So let's take a look at some of the other markets that are influencing the markets right now. First one would be the dollar. Dollar is very strong. Usually the dollar is at this moment in time is negatively correlated with the market. So in other words, the more that the dollar, this is UUP, the more that the dollar goes up, it puts stress on the market. So if we had a big move down in the dollar, that would most likely be positive for stocks. And why is the dollar so high here? The dollar is so high because of interest rates. And so it's propping up the dollar. The higher interest rates are propping up the dollar. So let's look at the dollar and say, okay, is there anything does anything look bearish here on this? In other words, could we hope for the dollar to go down? So in other words, the market would go up? Yes, there is something very bearish at the moment. So look at this high here. The high here we have, you see the green MACD bars? These are called divergences. So we had a very high move up here with green bars. Now, just a couple days ago, we were just as high as over here. But do you see how now we have no green bars? This is called the double top and a bearish divergence. I learned this from studying a one-on-one with Dr. Alexander Elder. This is one of his, he thinks it's the most powerful technical tool in trading, and I would have to agree with him. It's very, very accurate in a lot of situations, but you still need some kind of trigger. But here we have a high, here we have a high. This high had green, this high has no green. So in my opinion, whether it's next week or next month or a couple months, we are going to have a big move down in the dollar. And if we have a big move down in the dollar, that means that we'll probably have a large move up in bonds, which would lower interest rates, which would all be good for the market. So, you know, I was mentioning at the beginning of the podcast, there are a lot of signals right now on equities where we're getting to key support levels to the downside, and the dollar being high levels with bearish divergences kind of dovetails with that idea that we may be very near a low of a bottom, because the dollar with this bearish divergence looks very bullish, very bearish to me, which would be bullish for stocks. And then let's look at bonds. Bonds, of course, is really driving everything. And bonds, I mean, when you look at bonds, look at this move down. This is incredible. Again, when the price of TLT moves down, interest rate moves up. Interest rates moving up hurt stocks, obviously, as we've seen. But what I like here on TLT, which is bullish for stocks, hypothetically, and just a possibility, not for sure, is we have some really nice things going on with TLT. I talked about bearish divergences on the dollar. We have bullish divergences on bonds. Take a look at the low here. See the deep red MACD bars? The lower, the deeper these red MACD bars are, the more momentum to the downside. So obviously we had a lot of momentum to the downside. Then we rallied. We rallied into green. And then at the beginning of the week last year, are these lows lower than this low? These lows lower than this low? Yeah, of course they are. But look at the MACD bars. The MACD bars are not as deep as they are here. So we have a low with deep red MACD bars. We have a lower low with less red MACD bars. This is called a divergence. Essentially what this means is this move down here was not as strong as this move down here from a MACD perspective, and therefore the implication is we are running out of selling momentum. And if you run out of selling momentum, the implication is that you are going to go up. And then we did bounce here. We got to this trend line here. That stopped us. But see the trend line to the downside here? It's respecting the trend line to the downside here and finding resistance at the trend line here. But so do you see how we're forming this little wedge? The trend line to the upside is finding resistance, the trend to the downside finding support. So this is encouraging to me for bonds that we may break. We tried to break over that trend line on Friday, but we're still underneath it. But we're coming kind of to an inflection point where this is either going to head down or it's going to head up because of the double bottom bullish divergence here, and that we are holding the support in this trend line here. This makes me very bullish long term for bonds right here. And if bonds have a nice breakout, that will probably, at least in the short term, be positive for stocks as well. So hopefully this little analysis is just kind of a recap. The dollar looks bearish to me at the moment, which could be a good positive driver for stocks to go up because we have the double top bearish divergence. I think eventually dollar will come down. That should be bullish for stocks. Looking at bonds, just discussed that. We have the double bottom bullish divergence kind of forming this wedge here. This looks positive to me. If we have a breakout in bonds, that should also be positive for stocks. And again, stocks, we're at those so many key levels on those indexes as well. So hopefully that's helpful for you, kind of bigger picture. So at the beginning of the podcast, or near the beginning of the podcast, I did talk about that I teach private one-on-one lessons in the evening time via Skype. I love to teach. I have taught people from all over the world, from absolute beginners to absolute pros. I teach in the course that I teach all 5 of the different trading approaches that I use. I teach you every single step. We go through things ad nauseum. I teach you step by step every single rule. We do a lot of simulation trades. I throw a lot of curve balls at you because, and the reason I do that and I make it tough is when you're done and you graduate my class, I really want to make sure that you really know all the rules, all the nuances in trading, and all the things that I do. So if you're interested, the course does cost $1,750, but really it's a bargain. It's worth every penny for what you get to learn with someone that has traded through so many markets and has so much experience, 28 years of experience. And I think the best way to learn anything is one-on-one, rather than just in a large class with a bunch of people, and that's why that I offer that. So if you're interested, just contact me. My email is in the link of the description, and we could get a dialogue going as well. I know you'll be happy that you took the class. If you're not in a financial position to take the one-on-one course, I do have an online course available at udemy.com. It's a great course. It is 9.5 hours of video, 26 videos, 15 study guides. I've sold so many of these courses around the world. I've had so many good reviews, and it's so affordable. It's only between, I think, $12 and $15 on udemy.com. It's a great way to learn one of the strategies that I use, position sizing, scaling out. It's all included in that course. So if you're interested, the link is in the description of this video as well. As I mentioned before, if you like the podcast, if you found some value today, I would appreciate it if you could hit the thumbs up button. It really does help out the channel. It only takes a second to do it. So if you found something valuable, I'd appreciate that. And then, as always, I like to leave off, please try to go out and do something nice for someone today. one nice act of kindness will make their day. It will be good for you as well. If you could also go out and try to do one nice thing for an animal today, I would certainly appreciate that. I was raised with so many animals growing up, and they appreciate acts of kindness as well. So, if you found something valuable in this course, best way to repay, just go out and try to do something nice for someone today and an animal as well. All right. So we'll see what happens next week. Yep. It's been pretty brutal lately for sure. And I just wish that we have some peace in this world, and I hope things resolve themselves on all these conflicts going on in the world. And so, say a prayer, send some good vibes that things will resolve themselves more peacefully than not. And God willing, I will be here next week, and we'll see what these crazy markets are doing. But please be careful on your trades. Wait for your signals. And if you have any comments or questions about anything I said in this video, please put them in the comment section, and I'll do my best to get to them. Okay? Thanks so much, everyone. I have to leave it off with a cough, dang it. Thanks so much for coming, everyone. Appreciate you being here. And on the way out here, I have to run the U.S. legal disclaimer. Thank you so much. Talk to you next week, hopefully. Bye-bye.
U.S. government required options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.